Now, welcome back, ladies and gentlemen. So we've, as you know, split into two groups. So this, I might have your attention. Thank you. So we're split into two groups. This session, up until lunchtime, we'll concentrate on the prevailing housing crisis. So next three speakers will give different perspectives on the crisis. Seemingly an insoluble problem that has grown up over several years in Ireland, but also elsewhere, maybe in the UK, very similar problems. Problem was a major issue at the recent general election and has been very topical since. And whilst we could say all the major parties seem to agree on what our destination should be in terms of accommodation numbers and things like that, there's a huge variety and variation in opinions given on how best to get there. So we'll explore that with the three speakers. First speaker in this session is Marian Finnegan, Chief Economist of Sherry FitzGerald Group, graduate of NUI Galway with an MA in Economics. Marian became the first economist to be employed by a property company in Ireland, when she established the research arm of Sherry Fitz in 1996. As Chief Economist and Director of Research, Marian's role involves monitoring and analysis of economic and property indicators in the domestic and international media, and she's also one of the most highly regarded commentators in the industry and has appeared on television, prime time, etc. And Marian was appointed to the board of Sherry FitzGerald in 1998, so we'll ask Marian first to give her take on what should be done with the crisis. Thank you.
Thanks, Martin, and good morning, everybody. My presentation is really setting the scene, I suppose, for the property crisis. So I'm going to talk to you a little bit about the demand-supply balance for property in Ireland. So I'm going to begin by looking at the economic position, because clearly we've moved through a very, very difficult recession, and that has had a very damaging impact on all aspects of the wider economy, but very particularly on the property market. And I suppose you could argue that the property market led us into the recession and arguably began to lead us out of it in 2012. So I'm going to set the scene a little bit in terms of the economic backdrop, and then talk to you about the demand factors for property. So what is driving the need for greater accommodation in Ireland, which are largely demographic factors, and then look at how, as a nation, we're responding to that need, where construction activity is and how much units are being developed, and how that demand-supply balance is leading to price inflation in different regions in the country, where the greatest needs are, and where we see that market evolving over time. And I suppose the simple summary of what I'm about to say is that we are now in recovery mode in terms of our economy, but our property market is still very, very dysfunctional. And you can see that as we go through some of the data. All the data that I'm presenting today on the property market is determined by our own network of offices throughout the entire country. We sell about 12% of the units that transact in Ireland every year. So we get hard information on every single transaction, which we then use to form our opinion on what's happening in terms of the property market. So to begin with then, in terms of the economic backdrop, this is the Department of Finance view of the Irish economy, where we are now and where it's about to go in the next number of years. The first thing I should say is that these are all pre-budgetary forecasts for 2015, and they've all, to date, as the different stats come through, they're proven to be quite conservative in their nature. So, for example, they had forecast the economy would expand by about 6.2%. There's every indication now that would be in the high sixes, closer to 7% in terms of expansion. They had forecast an unemployment level of 9.5. The end of year figure came in at 9.1, and significantly less than that in the key regional areas around the country. And the positive news really for property, if you're looking at what the key leading indicator for the property market is, it's all around the consumer and employment. So as the unemployment level is being reduced throughout the entire country, that has a very positive effect on the availability of people's need for property. In other words, their ability to buy property. Consumer sentiment leads into their willingness to buy property, and the consumer expenditure figures there of around 3.5% for 2016, while still low enough in relative to where we were a number of years ago, does reflect a consumer who's now confident in recovering and willing to spend again. But unfortunately, property is still quite dysfunctional. Probably the most important economic indicator for property, however, is the labour market. So if you've got areas of very high unemployment, that area will have a depressed property market for a lot longer than those where we see a recovery. So you can see this is the range by region across the entire country of our unemployment levels. The average at the end of the year for the state was 9.1%, but the range was anything from 7.4% in the southwest, led by a very significant recovery in the Cork market, to almost 12% in the southeast, their near neighbours, where unemployment remains a stubborn issue, where it is negatively impacting the recovery in the property sector. The west is close to the average at 10.6%, but certainly Galway within that. If we could get a figure for Galway, the unemployment level is likely to be a lot more healthy than that figure would suggest. But into this recovering property market, we've had significant levels of intervention. And if I could say there is one thing that typifies the property market in Ireland, it is very significant intervention, and it is to its detriment. 12 months ago, in February 2015, the Central Bank released new mortgage macroprudential policies on the regulation of the mortgage industry. Their intention is absolutely laudable and absolutely correct in that they want to regulate and prevent another credit bubble. Unfortunately, when you bring about a change to a market and how lending occurs in that marketplace, the immediate impacts cannot be what was desired. And I think the immediate impact on the marketplace has been quite damaging. What these new rules have brought about is they have delayed, particularly first-time buyers' ability to buy property. And some would argue, well, buying property too soon is a bad idea. However, we've had at least 5 years prior to last year where the ability to buy property was severely affected by, or severely hindered by the recession. So we had a lot of first-time buyers, pent-up demand, willing to enter the marketplace, having had reasonable savings there. And what this has done is actually hinder their ability to buy property in the short term. Now, it's more obvious when you look at areas of higher value. So if you look at the Dublin market or the Mid-East market, where values are typically about 30% higher than the country overall, you can feel the very direct impact of the central bank regulatory changes. They also brought out a rule there, you can see in the middle, regarding loan-to-value for buy-to-let mortgages. And really they were stating that there should be an incentive amongst banks to lend into the buy-to-let sector. That, while banks are certainly offering mortgages up to an LTV of 70%, they're at quite punitive rates, and therefore they're not attracting a lot of investors. So we now have a marketplace where we have a growing need for accommodation, where people are being restricted in terms of their ability to buy in the short term, and they need to save a larger deposit, up to 20%, and their loan-to-income ratios are restricted to 3.5 times their income, which is good in its intent, but it does damage the market in the short term. So just to put it in context, if you look at the median value of property in Dublin and the median income level, the relationship between the two is 4.5 times. So for the average property in Dublin, if you're earning an average income level, you will require 4.5 times your income level to buy property, but you can only borrow 3.5 times your income level based on these new changes. So it does damage the ability to buy. The other significant intervention in the last 12 months was around rent certainty. So around the same time, the Minister for the Environment announced that he was going to look at the whole area of rent certainty and the ability to bring in some certainty for those in the rental sector going forward. This, again, there was a lot of discussion around this for several months before we got some final decisions around what that rent certainty would look like. And the legislation came out at the end of the year. And at the end of the year, I would argue that the result was not what it was originally proposed to be. It was actually probably a watered-down version of the original proposals. But in the intervening period, we did see significant concern from investors in the marketplace, investors that were a vital ingredient in the marketplace. And the result of that was restricted levels of investor activity and further pressure in terms of rent. I'll go back to that topic in a moment when we're looking at overall volumes of investor activity and how that's impacting the marketplace. But to look specifically at the demand and supply factors for property in Ireland, first of all, we are looking now today in that we do have the property price register, which gives us at least a glimpse into what's happening in terms of property. It doesn't give us all the details that we would like, but it gives us more data than certainly we had 5 or 6 years ago. So for 2014, I know this sounds old information, but we still don't have final figures for 2015. For 2014, about 42,000 transactions occurred, single transactions occurred in Ireland throughout the entire country, which represented 2.2% of the private housing market. And people often look at that and say, well, is that good, bad? What does that mean? Well, a normal functioning housing market should transact between 3 and 3.5% of its private stock every year. If you look at the UK market today, that's what's happening on the ground. In 2014, the Irish property market transacted 2.2. Our estimate at that point would have been that we would have seen that level growing, that we'd get closer to 50,000 transactions in 2015. I think the market will fall shy of that, partially because of the significant intervention. The figures for the first 9 months showed that activity was up 21%. However, the figures for the first 6 months had shown activity was up about 30%, so we definitely saw a tapering off in activity in the latter half of the year as the full impact of the new mortgage regulations became clear to those trying to invest in the marketplace. So overall, I think we'll probably see 47,000, 48,000 transactions at its utmost for 2015. Spread throughout the entire country. It must be said that the greatest impact of the new changes were felt in the Dublin market, which houses 28% of the population, so therefore it did have a big impact on overall activity levels. Just looking at who's buying and who's selling this property, because that gives you a very good indication of the functionality of the marketplace. So these figures are not from the Property Price Register, they're from the FitzGerald analysis of our own vendors and purchasers throughout the entire country. And for that reason, they are from a smaller sample than the entire market, but as I said, we've about 12% market share, so it gives you a reasonable indication throughout the entire country. So it was predominantly in 2015 an owner-occupier marketplace. 72% of the properties we transacted were owner-occupiers. And given the location of the conference today, I thought it would be interesting just to look at Galway as well. Galway had a higher level of investor activity. 56% owner-occupiers purchased the properties in Galway, 32% investors, whereas the national average was about 19% investors, and indeed Dublin had lower again at about 14% investors. Now, if you think of a marketplace where we have delayed purchasers' ability to enter the marketplace, more and more people need rental accommodation. The population is growing, and I'll share you some of those figures in a moment, which is putting increasing need on every year for more accommodation. And the investor activity as a result of that needs to be enhanced to supply the buy-to-let property, so those of us who want to rent find that property easily enough. What we have now is quite a dysfunctional marketplace where 19% of those buying are investors, which is quite low relative to the profile of vendors in the marketplace. So there's a lot more vendors leaving the property market in Ireland than we have new entrants in terms of investors, as a result of which we see a contraction in the level of buy-to-let properties available for everyone who wants to rent in a market where the demand is growing. Now, I'll talk to you a bit more about that in a moment. In terms of mortgages drawn down, about 4.9 billion euros in total of mortgages were drawn down last year. Now, because we don't have the final figures for transactions, I can't give you the precise level of cash from that analysis. But for the first 9 months, if you compared the level of mortgages drawn down in absolute terms to the level of transactions, 46% of the transactions had no mortgage at all attached to them. It wasn't that there was a percentage of the overall value. 46% of each individual of the entire transactions had no mortgages attached to it at all. Now, if you think back to the central bank regulatory changes, it was all about preventing a credit bubble. Well, the activity levels for last year and the year before, and the year before, and the year before, typically half of the transactions that took place throughout the entire country had no credit attached to them whatsoever. So it does beg the question why we were looking to prevent a credit bubble at a time when there was very, very low levels of credit relative to the entire marketplace overall. In terms of the need for housing, we have a growing population. At the time of the last census, there was 4.58 million people living in Ireland. We're doing another census on the 24th of April. Early indications would suggest it would be around 4.69 million, which is on target to what the forecast had been 5 years ago for population growth. So in the last decade, the population of Ireland has grown by about 12%. With that growth in population, there is a growing need for accommodation in all of our cities in particular, because what we've seen during the recession is population has congregated back in the urban areas. There's been a push towards the urban areas where people are seeking employment opportunities. That population is forecast to grow to about 5 million over the next decade to 2026. In the west, the population growth is quite strong, growing to just under 500,000 in the western region, of which Galway would be a significant driving force. So in terms of the housing need, with that population growth, we needed to be building between 22 and up to 34,000 houses every year to supply the necessary accommodation to house our people as the population grows. Within the western region, that's between 2,000 and 3,000. And if you look specifically at the need for Galway City, we should have been building in the order of 500 to 750 houses per annum in Galway City to meet the growing needs of the population of Galway City. Last year, we built less than 100 in Galway. So 1/5 of the need in the country of the city was actually supplied, most of which will be standalone properties which are not actually coming in and meeting the needs of those moving into the city. So there's a growing shortage with every passing year of accommodation in the country overall. In terms of what we actually built in the state, we built about 1,000 properties every month last year, in total about 12,000 properties. So a need for in the order, if you average it out over the whole 15-year period, about 25 to 30,000 houses per year, and we built 12,000, half of which were standalone properties that somebody with a half-acre site in Longford or Cavan or wherever it is, building a bungalow by themselves. And we're not actually meeting the needs of growing urban population as a result of that. And Galway City is a classic example of that, building less than 100 houses last year with a need for somewhere between 5 and 750 units actually every single year for the last 5 years. Just in terms of what's available then, what we do every 6 months in FitzGerald research is we look at the quantity of properties advertised for sale, and this is a very, very useful indicator for what's going to happen in the property market in the next 12 months. So in January of this year, we looked at everything that was advertised for sale on Daft, everything that was advertised for sale in My Home. We merged the data and we cleaned it on a county by county basis and said, what does that mean for the housing stock in every county in Ireland? So in total in January of this year, there were 26,800 units advertised for sale, which represented 1.4% of the housing market. Now, if you think back to what I said about transactions activities, which are around 2.2 or 2.3%, a normal functioning housing market should have at least 1 year's supply, ideally 2, but at least 1 year's supply available for the population to offer choice. So as of January of this year, we had 26,800 units and we had sold in the order of 45,000 the previous year. So we've nowhere near 1 year's supply. But it gets worse when you get into the urban centres. So you look at the Dublin market, it's averaging less than 1%, 0.9% stock advertised for sale in Dublin. Galway City, 0.7% of its stock available for sale as of January of this year. And similar figures for Cork City, 0.7%. Limerick has slightly more, around 1%. But literally every urban centre, all of our regional centres, have less than 1% of their stock advertised for sale, when they're transacting closer to 2.5 or 2.6% of their stock every year. So that represents a critical shortage of properties available to buy. And if you looked at the latest figures from Daft, you can see there's equally a critical shortage of properties available to rent. So we have a recovering economy with a growing population need and very little stock available for our people to either buy or to rent, which is putting significant upward pressure on both rent and capital values throughout the entire country. Just look at Galway, because we're here, let's look at it in a bit more detail. In Galway City, as of January of this year, there were 220 houses advertised for sale in the entire city. 1,300 in the county. Both of those figures represented a very significant contraction in 12 months previously when there was very little available for sale. So the biggest crisis for Galway City at the moment is there simply isn't enough accommodation for everybody's needs. People are bulking up at the properties that are available if they're looking to rent, but there is still very significant rental pressure pushing through. Just in terms of who's selling the property, and this will really illustrate the rental crisis as anyone who is studying here will have experienced in September last year when you were looking for accommodation. If you look at the profile of the country overall, 33% of the stock that we sold last year were investors, landlords getting out of the market voluntarily, or for want of a better word, and a further 13% were the banks pushing the investors out of the market. So 46% of the stock that we sold in the entire country last year were investors being pushed or voluntarily leaving the housing market, and only, remember, 19% of the houses were bought by investors. So in summary, for every one investor who bought into the marketplace and became a landlord, 2 got out. So there's no wonder there's a shortage of rental accommodation throughout the entire country. Just as critical in Galway, we said there was a higher level of investor activity in Galway. There's equally a higher level of investors getting out of the marketplace. 38% of our sales last year were bank repossessions, and another 30% were selling investment properties. So that's 68% of the houses that we sold in Galway City were investors getting out of the marketplace, and only a little over 30% were investors buying into the marketplace. So again, the rule of thumb again, 2 leaving for every 1 coming in, and that's what's pushing the rents up in Galway City overall. The national figures from the PRTB shows rents were up about 8.5% on an annual basis up to the end of the third quarter last year. We don't have the fourth quarter figures as yet. But I think if you look at the core areas, you get into the cities of Galway, Cork, Limerick and Dublin, you'll find rental inflation significantly in excess of that average figure of 8.5%. And certainly there are examples where it's in the high teens, pushing towards 20% for different types of accommodation. And that really reflects the market in crisis, which is what we're here to talk about today. In terms of price performance, it hasn't been quite as strong in the last 12 months. So the market moved into recovery in 2012, and we saw a significant uplift in values throughout 2013 and 2014, largely led by the Dublin marketplace. But the intervention in the Dublin marketplace combined with the previous couple of years of very strong price inflation, did see that market cool quite a bit last year. So we saw much lower levels of capital values being pushed through the Dublin market. So the average figure for the country overall came in at 4%. But what I've done here is look at our own index by region in terms of the entire country. So you can see the Galway region and the West overall had capital values growth of about 7% over the course of 2015. The Southwest and the border regions both closer to 10% price inflation. Arguably the border region coming from a very low base when you look at areas like Donegal where values had been depreciated quite significantly. The Southwest is on the back of 2 years of recovery, so it's very significant price pressures emerging in Cork City at the moment, and a recovery in Kerry coming from a low base in that location. And then you can look at the Dublin market there, where we had very, very significant capital value appreciation throughout 2013 of about 14%, and throughout 2014 of about 18%. And last year, overall, the value of property rose by about 1.4%. And that really and truly reflects a couple of things. It reflects the previous couple of years where we saw that surge in terms of price performance, but it also reflects the intervention in the marketplace where people simply delayed their decision to buy until such time as they could save the 20% deposit in order to get into the marketplace. And I suppose it's quite stark if you compare the 2 years there, 2014 to 2015, you can see the intervention in the marketplace and how that impacted price performance. And arguably you could stand here if you're representing those who brought about those changes and say, well, this is a success story. You know, prices in Dublin were growing by 18% in 2014. We came in, we changed the story, and now they only grew by 1.4% in 2015. But the problem is there's no new housing being built, and the market isn't. The problems in the marketplace have not been addressed. We simply moved it from a position of very strong price growth to very strong rental growth, and we still have no more properties available for our citizens. And that is the biggest issue for the housing market. So I suppose when you start this presentation, it is quite frustrating because you look at it and say, we have such a deep recession and the economy is recovering. Arguably well positioned in the recovery because of what's happening in terms of euro and the very positive impact that's having on our export trade. We are also seeing an improvement in consumer sentiment. It's back at an all-time high. We're seeing reductions in unemployment levels down to about 7%, 7.5% in our core areas. We're seeing very strong positive investment in our economy overall, and we still have an incredibly dysfunctional housing market. And if there's one thing that we could get out of all of the talk that is in Ireland about property, is that we could get a plan that lasts for more than 12 months. A need to look at this property market for a 20-year period or a 30-year period where we would say, this is what the property market of Ireland needs to supply its needs over the next 20 or 30 years. This is going to be our population growth. This is the amount of houses and unit types that we need, and allow those to be developed. So we offer choice for those who want to rent, for those who want to buy, and that it isn't constantly a changing marketplace and a changing environment every 6 months as somebody else comes up with a good quick fix solution, which usually has consequences that weren't intended. Thank you very much.